Hello everyone, Mr. Clark here. Today we're talking about stocks again with the stocks, but more on the side of transaction fees. So I want to go ahead and get started in this. I want to use my screen up here. We have um, something we need to know about stocks. When we buy a stock, it has to be done through a stock broker. It has to. We cannot do it ourselves. There's a lot of legal issues in licensing. Whether you believe that's a fixed reason for you to pay more for stocks or what, there's a lot of issues with insider trading, with other trading practices that are illegal, and we have to avoid. And so stockbrokers have to make that trade. They charge a broker fee that can be a fixed flat fee, or that can be a percentage or commission. The fixed is a fixed dollar amount often used by discount brokers who aren't going to give you any stock advice, any help. They're just going to make the transaction. You've done the research. The commission based is largely for people who are looking for someone to offer extra advice. So they're paying the fee to get that extra advice in there. But either way, this is money paid on top of every purchase or sell of a stock. You can buy on the market, buy at the market. I can write, I promise. I don't have to because I'm a math teacher. We don't do writing. Buy at the market, or we can do a limit order. There are other variations of all of this, obviously, but the two basic ideas are buy at the market, which is saying, I want you to buy at the best possible price. Of course, the stockbroker has a different view of the best possible price than maybe I do if I don't have a lot of extra money lying around to just throw at it. So I might place a limit order. Again, this might be the best price. A limit order says this is a fixed price. It's like if you go on eBay and you're going to bid on an auction and you say, I want my highest bid, that's this piece right here. We're saying that's the most I will pay. That is the limit. However, if the broker can get it cheaper, they're going to go cheaper. Well, maybe if you have a decent broker. At the end of the day, when you look at the fees you pay brokers when you're buying or selling the stock, compared to the amount that you gain or lose, your net proceeds represent the amount of money you make after broker fees are subtracted. So your net proceeds, you can look at net, this is after fees. So let's do an example. So let's say Lee has two transactions he's going to do today. Instead of lumping them together, maybe the stock market goes down just a little bit. So his first purchase was $3,456. He paid that. He also pays a dollar fee of $12. So now he's paying a total of $3,468. That's how much he would pay, except he made another purchase of $2,000. So then that would put him at $5,468, but not true because he also paid a fee there of $12, $5,480. That's the total amount paid, which means to make any profit off of this thing, he's going to have to sell at least $5,480 to cover his current expenses paid in, but then he's also going to have another fee depending on who he uses. So let's pull up another example here. We're going to take this company, Tensor Brokerage, which is a brokerage firm. That's all they do. And they've got a clientele split between what they're going to charge. So first of all, it's a bit outdated just because you don't see a lot of this happening anymore. It can still happen, but it's not as common as more and more people are online and doing a lot of this actually themselves without even contacting people, but that's okay. So if you're sitting at 250,000 or more, you're going to pay $12 per each trade. So you save $3 based on a higher portfolio, like you've got a better relationship with that firm. You're still going to pay $9.50 if you're doing anything online, but they're going to give you a 4% if you use a broker. So you're saving, sorry, not 4%, 0.4%. It's an extra 0.1% added onto that, and an extra $3 if you have less than 250,000, and same 950 for an online. So we'll take Adriana. She has a portfolio balance of $11,250. She definitely fits in this range here. She wants to make a trade. It's going to be minus $15, which she's going to pay. And it's 5% on top of whatever that trade is. Let's say she purchases $7,000 worth. 0.5%, excuse me, is going to be multiplied times that. And you're going to add the 15, or I should say subtract the 15, that and the 15, because we're looking at the total cost. I wanted this in a term of a negative, and 0.005 would be the decimal equivalent for that. I believe that gives us $50. This is going to be her cost, a negative $50 to her bank account to whatever. So she has to make at least that plus whatever more when she sells back. So we have to understand that selling and buying are both going to incur some kind of fee. If you're selling with a portfolio, maybe you get a discount. Who knows? But you're going to have to deal with that one way or the other. Another example could be, we're going to say, let's see, Erin purchases 23,000, let's say $510. Sure. She paid a 1% fee. When she sold it for 27,300. It had gone up in value. She decided to use a discount broker. So we're going to say these are her costs that she has incurred. So on the first one, we have 23,510 times the 1%, or 0.1 if we want to use that. That'll work too. And actually, I would probably go and just say 1.1, but we can say, oh, and the original 23,510. So there's that multiplication plus this piece. I get 23,745 and 10 cents. That's 23. There we go. When she sells it, she sold it for 27. She used a broker that charged $21. So just subtract the 21. And I get 27,279. So that's her sell price. Sell price minus the purchase price is our taxable gain. So in our calculator, we'll go ahead and do that since it's a large number. 27,279 minus 23, 745 and 10 cents. Of $3,533.90. This is her net proceeds. Or we could call this taxable gains, because that's what it is. We say it's taxable gains. Technically, this could be done inside a tax-free account. We're not going to go into too much, but like a 401k, where you can make your own purchases, or an IRA that you can also have. You can make purchases, buys and sells and all this, right? You still pay your fees, but you don't pay any taxable gains until you actually receive money. Essentially, what happens is that taxable gain doesn't happen until the money goes into your checking account. So if you have a Fidelity or a Vanguard account, for example, and you're making purchases, you can do this all you want, and the taxable gains isn't going to show up as something that you have to pay with until the money moves into your account. They will still look at your value and determine whether you have to pay taxable gains or not, but you won't actually have to pay them until you receive the money. So let's do just one more example, because I just want to make sure we've got this understood and how to do this. So we'll just do one more. We're going to say Yolanda. I always like the name Yolanda. I think Yolanda had a yak, didn't she? So she purchased stock for $7,000. Again, books may not put the negative sign in there. I'm doing it. It's an accounting thing, really, to understand that this is money going out. We paid a 1.5% brokerage fee. It's a lot higher. It's a negative 1.5 on that. So if you're going to think about this, you can say 7,000 times a negative 1.5%, or I should say 7,000 times 0.015. Still going to need to subtract off another 7,000. So it would be this minus 7,000. And that's going to lead us to, let's see here, let's just go ahead and calculate it. We took 7,000 times 0.015, so $105. We're going to take that as a negative and minus another 7,000 because that's the actual purchase, 7,105. You could also just say, hey, let's take negative 7,000 times 1.015, so 7,000 negative times 1.015, same result, right? Same thing, because we're taking the original piece plus the extra fee taken off of that. So it cost us $7,105 to do this. Let's say the stock market started going down. We're getting a little concerned, so we sold it for $6,325. So that's 7,105 plus 6,325, and we also have a brokerage fee there, but it's only 5.5%. When we look at the actual proceeds, the transaction is this much times. So we're going to say 7,105 plus 6,325 minus that 6,325 times 0.05. 0.5, sorry, 0.5% or 0.005, right? So when we calculate this out, same thing, 7,105, we're going to add back the amount that we sold for, 6,325, oops, 7,105 negative. Gonna type this right in our calculator, or we're gonna get some really weird numbers. 6,325. We're at a loss of 780, but we also have to subtract off 6,325 times 0.005. And so we're still really sitting at negative $811.63. Again, even if we lose money on the deal when selling a stock, we're still going to lose, right? We're still going to lose on that transaction fee. It's not like they're going to say, well, you sold for less, so we're not going to charge you. This value right here is still going to be our actual loss. So when we said, well, when we sold it for our 7,105 minus 6,325, oops, 7,105 minus 6,325. That 780 was a loss. And then we also lost an extra piece in here. We had an extra, $31, $32 almost, just in fees alone. Maybe a flat rate broker would have been better for that deal than selling a discount broker. But regardless, these are just examples of when we're doing all these problems. So at the end of the day, we really have a few things we need to understand: what a brokerage fee is, what a commission versus a flat rate fee is, that we pay that on every transaction regardless of how many transactions we make, and regardless of how many stocks we make, it is on the transaction itself that we're paying that fee. If you have questions, please shoot me an email. This is a fairly straightforward lesson. It's just calculating fees, but just make sure you understand the concept that that fee is getting charged every time, so that you don't find yourself paying more on stock than you expected to, and otherwise cutting down into your overall return. If you have questions, shoot me an email. Take care.